welcome to our market update here from Compass Consulting and Financial. It is our first market update for Compass Consulting and Financial, but it is actually our third market update of the year here. We're excited to have all of you guys here. I know we had talked about doing this as an in-person update. However, with several of our communities still recovering from back-to-back hurricanes, I decided that for the safety of our clients and to give a little bit of a break to my staff, we are going to do a recording of the market update. And as you can see, we have a guest speaker with us here. Keith was actually going to join us in person, but he actually now gets to join us from the comfort of his home. But we're going to go through some questions and then we're going to upload this to our YouTube channel. Since we will not be open for questions, if you do have any questions or concerns about the market or your portfolios, remember to refer to your financial plan, but reach out to our office and get on my calendar and I'll be happy to answer those questions for you. Welcome, Keith.
Thank you.
Keith Girand is the Senior VP of Business Development and works with Lear Investment and has been in finance for almost 30 years. We have actually had the privilege of knowing each other for the last 6 years. So Keith, welcome to our market update. Now, I know with the markets today, especially, there has been a lot of volatility over the last 6 to 8 weeks. Can you give us any thoughts on why this is?
Sure. First of all, thanks for having me on. I'm honored. There's a couple of things. I mean, we personally have been saying for a while to be, prepared for a wild ride, which, we're starting to see, being played out. We're coming out of September, which is typically historically the worst month for stocks. We are heading into what is typically a good period, the fourth quarter. But in general, I think there are a number of reasons. One, you have monetary policy, which has been very restrictive. I mean, prior to September 18th and the Fed cut rates, you had, there was a lot of speculation in terms of how aggressive the Fed was going to be, how much, how often. And you haven't really seen this restrictiveness or restrictions since both the dot-com and the great financial crisis. The other thing is that you do have some profit taking. We're now heading into earnings season. You have an upcoming election, which sometimes translates into an anticipation of all sorts of sectors that may do well or may not do well, or gee, if he or she's going to become president, I want to be in this or want to be out of, a lot of people. I mean, we've heard crazy things like, well, if so-and-so gets elected, I'm going to pull all of my money out of the market, which is just a horrible idea. But then you have, the escalation in Israel. So there are a whole slew of things that are causing the, market volatility. I would also say that that the rate cut that we had, the 50 basis points, is also not a panacea. I mean, Milton Friedman said that the economic impact of these rate cuts is a long and variable lag. And so you might see some immediate repricing in terms of loans or in interest rates, but it's going to take some time for this cut and future cuts to kind of work through the system.
Now, with this being currently in earnings seasons, which is where I think we're getting some of the volatility that we saw in the market today, is just because of earnings after markets. It looks like Tesla's earnings are going to be a bit of a surprise, so that'll be interesting to see what that does for the markets for us tomorrow morning. But what are the expectations with this current earnings seasons? First quarters kind of came in as a surprise that companies did a lot better than expected. Second quarter looked like we were going to be relatively flat to positive. And we can't keep continuing at this momentum, can we? Are we looking at some more flat to negative earnings in this season?
So effectively, we're in the second full week of earnings, right? Last week, we had financials and the banks, which were by and large better than expected. And so this phrase is kind of key because this is what keeps coming up. It's like better than expected. The economy and the credit is pretty positive. This week, we have a hodgepodge of industries. You have things like Lockheed Martin and Hilton. But the question is sort of like, well, if things are coming in better than expected, like, well, why is the market down? Like, why are we having this sort of volatility? And in short, it's because of the overall market performance. It's hard or difficult for companies to come out and give guidance that that sort of that's keeping these stocks at this level, right? It's difficult to come out with guidance and keep these stocks at this price. But the economy is solid. The areas where we do have weakness sort of remain weak. They're not increasing in weakness, but the overall economy is in good shape. The other thing I might add is that, we're also in this sort of weird kind of reporting season where the companies are not giving guidance for 2025. It's just for the remainder of this year. So
Right.
2024 is kind of already, baked in. I think the next one that'll be important is going to be obviously the one then, I think the next one will be in February, which will be much more telling than this one. And then finally, I would mention that we're seeing interest rates rise on the longer end of the curve, and that's for a couple of reasons. And this still remains good for equities, but it's this consistent set of positive economic surprises, right? The phrase "better than expected" keeps popping up, and this has had a positive effect. And the other interesting thing is that there is a correlation between the increasing possibility of Trump winning, and hence, if you look at the chart and the odds of him winning an election, the longer term interest rates are rising as well.
Interesting. Now, speaking of interest rates, you had mentioned earlier that the Fed has already cut rates once, and with this first rate cut finally done, because we went back and forth, are we not, are we not? I felt like, I had a daisy and I just kept picking up, they love me not off the pedals. So the fact that we finally got this first cut done, where do you think we're going from here, not only with rate cuts, but what the Fed is actually looking at when it comes to cutting those rates, when it comes to inflation and employment? Because obviously the number one question that I see and I'm hearing from clients and non-clients alike is like, how can they tell us that inflation is down when I'm still paying more at the grocery store today than what I was 6 months ago? So where do you think we are going now, especially with employment still being as strong as it is?
So there's a lot in there, and hopefully we'll, get to things like, inflation so in short, you have a Fed that is absolutely laser focused on the labor market, as well as some other data points that could indicate a weakening economy. But we know now that they are not shy in using their bazooka, which has been known in the markets to mean a 50 basis point cut. So we know that they're not shy in using that. And this suggests that we have what we're terming as the Fed put, right? A put being a downside protection. So in other words, if economic data looks too weak, they will cut rates commensurately. And historically, this state of play is constructive for markets. For investors, this creates an unusual win-win situation, right? If the economy tanks, the Fed will cut rates to defend it. Stocks may pull back in the short run, but bonds may be big winners. If the economy meanders along, much like the Fed's projection of 2% GDP through 2027, stocks could be lifted gradually by lower interest rates that sort of serve to support valuations and a less restrictive economic climate, which is good for corporate earnings. In this case, bonds would simply provide a nice yield and portfolio stability, and stocks might continue to rally, to new highs. But in the very short term, as I mentioned earlier, we're exiting September into a seasonally favorable fourth quarter. So as long as the economic data continues at its current pace and interest rates decline, the conditions exist for a nice run, we think, into year end.
Do
You
we
know, the
see
market,
any surprises coming like we did back in 2018 where we expected a strong fourth quarter and we gave up almost 10%?
yeah, we don't see it. I mean, will the market, probably see bouts of volatility from, the upcoming elections and maybe some unforeseen circumstances, probably. But the point remains is that there's really more reasons to lean risk on rather than risk off.
Okay. Do you think that we have any concerns? I mean, we heard the word recession for almost 7 straight months last year and maybe the first couple months this year. Do we need to worry about stagflation or recession going into 2025, do you think?
So for stagflation, no. I mean, stagflation is when you have, high inflation, stagnant economic growth, and high unemployment rate at the same time. And the fact is, we really don't have any of those things. You have arguably inflation running at 2%, give or take, unemployment is at 4%, give or take, and an economy that's holding up pretty well. Relative to recession, well, will there be a recession? Yes. When? Who knows, right? There just will be one at some point. The scary part, though, is on the recession front is when you kind of look at some of the data. As an example, if you go back to the 90s and you look at every time the Fed raised interest rates, a recession followed. So you can go and look at 2001, 2008, 2020. And I'm not suggesting that it'll happen or happen soon. And perhaps we just get away with a soft landing, which seems to be the likely case. The only thing that I would also add, though, is that in terms of like rates, it's a much different world that we're living in than we have been, right? I mean, in the 90s, rates were, in the 6%. And then if somebody had said to you like, hey, in a decade, in 10 years from now, we're going to have 0% interest rates for the next 10 to 15 years, you would have said, what? Like, and in that environment, it's really easy to invest. Everything kind of goes up. And a lot of investors have had their portfolios in these, or their assets in a static portfolio, and they have done very, very well. But we're in a different world now where rates are, I don't know, 4.5, 5.5. And our view is that environment is just much different, and static portfolios aren't going to work like they once did. I'm not sure if you touched on it, but inflation, or you asked about it, but I'm sure you did. It was in there. Inflation, stagflation, and recession. But inflation, CPI is like the government's, favorite inflation metric, right? They take all the goods and services and then they add them up, and then they report some number, which then of course gets, revised. We tend to look at a much more in data points from a company called Trueflation, which actually looks at real-time data points and reports that inflation in real time. And when you look at it, it shows that inflation is running a little over 2%. And, my caveat is that, yeah, that's core inflation, right? And why it doesn't feel to me or to anyone that inflation is at 2%. You're like, you're nuts. And that's because these numbers that they report always exclude, right, the most volatile, which is food and energy. Think of energy, gasoline. The two big things that we do is we drive and we eat, right? We go to work and go play, and we have to fill up. And those two things have not really come down. And that's why I think it feels like inflation is still high, even though all the other metrics say that it's a little over 2%.
All right. I am going to skip the next question and come back to it later.
Okay.
So one of the unique points that you had brought up when you guys had sent out your notes and thoughts is electrification, and how is this truly going to affect the markets in the short term versus the long term?
Yeah. So as you know, we invest in themes, and our research has indicated that Uh, the electrification, energy, power is a huge long-term theme that has a secular tailwind that'll last for a decade or more. But you think more broadly about why energy is important to the economy. Well, energy is just the ability to do work, right? Modern civilization is possible because we've learned how to take energy from one form to another and then use it to work. So electrification is a form of energy, which in the short term we're already seeing that the grid is outdated. I mean, you have mainly in California, but you have brownouts and you have blackouts, and people can't use electric for so long. And so the grid is outdated. And of course, you have a current government that wants to run everything, through the electric, right? They want everything. You want EV cars. We can't handle that. And the main culprit of draining the electric or the capacity is these data centers. So there has been we've been on this theme for a long time, and it's kind of nice and kind of fulfilling when you start to see on CNBC when you see these things about nuclear power and microgrids. But I'll give you an example. It's these data centers, for example, in Northern Virginia, which has the most data centers in the country there. There's 135 facilities with more than 14 million square feet of space housing servers, and they have more than 2,200 megawatts. Well, so what? What is a megawatt? What does that mean? Well, to give you a comparison, 1 megawatt will power 1,000 homes. And these have more than 2,200 megawatts. So think about the miles and miles of electricity that is going through just the data center. And we haven't even touched on having to cool those data centers. In fact, data centers alone, the demand for the electricity in just data centers alone has increased 500% from 2013 to 2022. Dominion Energy, which is in Virginia, said that the rapid surge in power demand from data centers are overwhelming the grid's capacity to accommodate new connections. No more can be made in Virginia. They are literally at the end. So
but that's not only going to affect the corporate world, that's going to affect the residential world as well.
Of course. And so this leads to all sorts of other things, like, as an example. So now the data centers, I mean, we could talk about the data alone, which is what we call the new oil, but these data centers are now creating what are called microgrids. So now they're, instead of relying on Dominion Energy or the energy companies for their power, what they're doing is they're using now they're actually building we'll call it just a generator that's outside the data center, running natural gas line to the generator itself to create their own power to power their data center. And of course, then you look at, is that going to be enough? Is natural gas going to be enough? And now there's all this talk about nuclear power, which of course we've had, uranium in our portfolio for a little while now, knowing that this was going to be, and not just in the US, because people will say, oh, you're never going to get, the United States to build nuclear power. Well, you got to realize there's 7 billion other people in the world, and the demand in China and India between just those two companies and building nuclear reactors is off the chart. And there isn't enough uranium to even build them all.
So that's a great point, because I know a lot of people that, when we talk about the electrification, that it's always about electric cars, and it's such a split topic. You are either all for electric cars or you are not for electric cars. But you're absolutely correct. It's just there's so much more to the drain on the electric grid than, just weather. I mean, like,
Right.
within Texas, they had the rolling brownouts due to the extreme heat that they had in Texas this year. In Florida, just, two back-to-back hurricanes, on the fact that we had a major hurricane 2 years ago and a year before that. We're still building our electric grids here in the state of Florida to be able to compensate for, what these storms did. So there's so much more to it than just the electric car. So I'm really glad that you spent some time talking about that. Now I'm going to transition to AI. From the research that I've done on AI, we are 20 years out before AI is a real thing. I see a lot of companies that are transitioning to AI software, and then the next thing you know, they're transitioning out of that AI software because of the lack of security parameters. I think AI is interesting, but what is kind of where you guys are thinking? Because there's a lot that's going to go into making AI work, which takes us back to the electrification, because you got to have power in order for AI to work.
That's right. I mean, you have to have power to do it. And, we use this, this analogy all the time. It's just like, what is this thing, right? It's like the greatest invention maybe since, the internet. But if you don't have power to it, it's nothing more than a paperweight. But, speaking of AI, so I think a number of things that I think about. AI, it's here to stay. And I think that there are uses to AI that we haven't even probably begun to think of, and how it will be used. I think that a lot of times investors kind of want to go, they look at AI in and of itself, right? They kind of go, oh, well, what companies are producing AI, or what companies are in AI? I mean, all of them are. I mean, you have Google and Apple and Microsoft, and yes, all of those are in AI, but you have to think about, um, what businesses are going to benefit from AI. And you're right, it's years away. This new Apple iPhone 16 has the touch button on the side. If you notice the phrasing, it's built for Apple Intelligence, not completed, right? Because intelligence, it's going to take a very long time for them to institute fully all of the things that it's could be capable of doing. And it's going to take time to learn, the user. But we don't even know what we're telling it to use. Like, it could, like, just because it's listening to you and looking at all of your activity doesn't mean yet it knows how to respond to you with it. So for the long term, though, I will say that we believe that AI is going to play a huge role in medicine and in the healthcare field. When you take a look at radiology and the ability to spot cancers, diseases, things that way earlier than a human could, the curing of cancers, others diseases, research and early discovery, clinical development, the operational aspects, rapid summaries of scientific and medical literature, and the list goes on. But I mean, it's here to stay. I'll give you, if I can find it. We asked, we just like went to OpenAI and asked to create a photo, of Fed, the interest rates, and inflation. And it's amazing. You've got a robot on one side playing chess with the Fed chairman, and Washington, D.C. is in the background. You're like, when you look at that, you go, yeah, it's here to stay. It's a real thing. I just think, though, that we're just so on the beginning of it that
Yeah.
it's
Yeah.
almost unfathomable to think about the possibilities of it.
All right, so now we're going to transition to political. Now, all of my clients and prospects and those that follow us know that I do not like talking about politics. However, because we are going into probably the second most volatile election process that we have seen in my lifetime, which, by the way, is 50 years. I will be turning 50 next month. So, in 50 years, probably the second most volatile election that we have seen. And kind of sticking with that 50 theme, from some of the research that I've done, there's a 50-50 chance the market is going to go up or down, regardless of who is elected as president. And it's usually either short-term corrections in the market or it can be a little bit longer of a correction in the market, but it's a 50-50 chance, So when we're looking at our portfolios, there are some things that we can do to maybe protect some of the volatility in the portfolios, thinking if it's going to be Republican or Democratic, just because they both do have very different economic policies. But I've also found that the spread of performance of a Democratic administration versus a Republican administration is about 3%. So, if the Republicans get into office, the markets are going to go up or down. If the Democrats get into the administration, the markets are going to go up or down. But the difference of those two is fascinating. It's only about a 3% spread. But this time, Keith, feels different. Like this time feels like, depending on who gets into office, whether it's Republican or Democratic, I feel like there's just a little bit of a different feel because it seems like the policies are so opposite of each other. Taxes is going to be one of the things I want to talk about as we close up. But why do you think this time feels different? Is it just the media, or are there definite trends that we are either going to need to be concerned about, or trends that we're going to be able to take advantage of based on who is elected?
Yeah. So one, I hate talking about politics too. I have friends that are, on the opposite side of the aisle as that I am, and I refuse to engage. I just refuse to do it. Speaking of policies, let me attack that one first, because a lot of times people will look at investing based on who they think is going to become the president. We know kind of where they stand on a matter, and therefore we're going to try to take advantage of that. So if you go back to when Biden was incoming and taking office, we knew his stance on the matter of clean energy. We knew that was his stance. So on one hand, you could say, wow, I'm going to invest in clean energy companies. Yet when you look at the clean energy index, the symbol is ICLN. It goes just like this, straight to the bottom. So it's very difficult to kind of try to base an investment on who's coming into office. As you mentioned, the good thing is that whether a Republican or Democrat is in office, the markets go up. Do Republicans do better typically when they're in office? Yes, but the point being is that they still go up. And there's only been 4 times since 1928, so the last 24 elections, where there were only 4 times where the market was negative, right? So the fact is that it does typically, on average, right? I mean, you look at only 4 where you've had a negative year. So we just don't think that it's going to have a material effect. Again, the way we invest in terms of long-term themes with secular tailwinds, we know that electrification, fifth industrial technology revolution, we know that those biotech, healthcare, we know that those are long-term themes. So we don't really get distracted with who's coming into office, what those policies might be, because you can never really count on them.
Right, absolutely. Now, looking at some of what's going on in the markets right now, so one of the things I'm going to touch on that wasn't on your cheat sheet when I sent you a list of your questions is gold. Gold has, had an incredible performance. I hate using the word incredible performance only because I'm not a fan of gold personally. Because I have found that historically speaking, the ins and outs of the gold market are entirely too volatile. So when do you buy in? But most importantly, when do you sell? So what are your guys' thoughts on gold, and is it still a hedge or a safe bet? Because this time last year we were still talking Bitcoin, believe it or not.
Yeah, so you're right. So we have hated gold for years, years and years and years. I mean, Rick Lear, who, obviously the CIO, has, tried to stay out of gold for years. But and it's hard, to not look at the performance of gold at up, up 30% for the year. But it is when you there's a couple of things. I mean, when you think about scarcity of resources, right? But primarily you think, well, okay, gold is scarce, and therefore, we buy into that theme. But it's really, as you said, it's been a hedge. With It's been a hedge, the weakening of the dollar, and therefore, and with kind of really no places to go in fixed income for a long time. Now that's starting to change, but yes, that's the reason it's been used in our portfolio.
Okay. Now we're gonna go into taxes next, and the main reason I want to go into taxes is because this is the final market update of the year. And so our clients know that they're going to be getting their tax letters in the mail from us, reminding them how to prepare for tax season to make it a little bit easier. But going into 2025, and you're retiring, one of the things that we're looking at is trying to be able to educate our clients on. We know where taxes are at today, but we don't know where taxes are going to be at in January of 2026. Any thoughts on how to, protect our portfolios if we get into a new administration? It will be a new administration because it's, no longer going to be President Biden. So you're going to have either President Camilla or you're going to have President Trump. So what does it look like going into 2026 for taxes? Because it's not only going to affect middle America, and the average investor, it's going to affect corporations a lot. So is there anything going into 2025 that we can do with our portfolios to protect us against if those tax hikes come in 2026 and we're not able to find a happy medium?
Yeah. I hate to end on this one because this will probably be my shortest answer and probably the most unexciting answer. But the answer is that, no one knows. And I say that to mean that the reason no one knows is because no one knows who's going to take office. And furthermore, we don't know who's going to control Congress.
Right.
So the only thing that we can sort of say with certainty is that I don't think either candidate has the political appetite to raise taxes on the middle class. I don't think that there's an appetite for it, and I'm pretty certain that they're not interested in doing it. Why is this relevant to an investment strategy? Well, it could be that maybe these expirations will of course hit the individual, and then that's going to affect consumer spending, and then that might affect the services sector. And, therefore we might want to not be in those sectors or in those, companies. But again, going back to, we don't look at investing like that. Again, we're in themes for the long term. And we have, conviction that they're going to be okay in the long term. But yeah, in short, we just don't think that either one of those candidates, is interested in raising taxes and letting those expire. The other thing is that at the end of the day, we don't think that it'll have much of an effect.
All right, great. Well, Keith, we appreciate you for joining us. It might have been a short answer, but it's okay because I know it's a concern for those, especially those that are thinking about retiring. Do they retire in 2025 or do they continue working for another couple of years? As always here at Compass Consulting, we are always looking at the financial plan because we can actually plan for higher tax rates or we can plan for tax rates staying exactly where they're at now. Review your financial plan. If you don't have a financial plan, please reach out to us here at Compass Consulting and Financial. We'll be happy to get a plan in place for you. Keith, I don't know if I'm going to get a chance to talk to you beforehand, so have a happy Thanksgiving
Thank
and
you.
a very merry, happy holidays.
Thank you. Same to you. Thanks
All
for
right.
having me.
Thanks. Take care.
Bye.